Congratulations! You have retired or are thinking about doing so soon, and you have followed all the good advice to invest in your HSA. As with many things, how you treat your HSA should change dramatically once you retire. Today, we're going to talk about that. Hi, my name's Melody. I retired last year at the age of 55, and this channel is about sharing what I have learned along the way about retirement finances and lifestyle. Today, I want to share ways that you may be able to use your HSA in retirement. Now, it's important to note I am not a financial professional, so you should verify this information for yourself. I'm not going to bore you with talking about what an HSA is, the tax advantages, and investing it within the account. I'm assuming you already know this information. And if not, there are plenty of other videos on those topics. What people rarely talk about is what do you do with it when you actually are retired. Many people treat their HSA like an account they should never touch. But in retirement, I believe the question is not, how do I preserve this money forever? The better question is, how can this account help support the life I want to live? First, it is important to understand why you should spend your HSA now. The triple tax benefits of an HSA can pass to your spouse at the end of your life, but not to your other heirs. So it becomes a use it or lose it scenario. For this reason, I personally have changed my approach from saving as much as I could in my HSA to spending it. And the first way you can use your HSA is the simplest. Pay for your qualified medical expenses. That can include out-of-pocket medical costs, dental care, vision expenses, prescriptions, and over-the-counter medications that are eligible. These expenses are easy to overlook because they happen gradually. A prescription here, a dental bill there, new glasses. But over several years, those costs can become a meaningful retirement budget. I actually had some dental work last year that wound up being several $1,000s, and boy, was it handy to have my HSA to spend on that. And so this is where I want you to pause and look at your own spending. You may already be paying these expenses from your checking account while an HSA sits untouched. The second strategy is reimbursing yourself for eligible medical expenses in the past. Now, this is one of the most flexible features of an HSA, but only if you have good documentation. You generally need to show that the expense was qualified, it was incurred after the HSA was established, you did not already receive reimbursement, and you should have the receipt or other supporting records. For example, suppose you paid several $1,000s in medical and dental expenses over the years using your regular checking account. If those expenses qualify and you save the documentation, you should be able to reimburse yourself now. That can help pay for home maintenance, travel, or another retirement goal, but indirectly. The HSA reimbursement is for the past medical expense, and you're just paying yourself back. The third strategy involves items that qualify with a letter of medical necessity. Some products are not automatically eligible for everyone, but if your doctor documents that an item is needed to treat or manage a specific medical condition, it can qualify. Examples of this can include shoes to work with your orthotics, grab bars, or even massage or acupuncture. The key is not whether the item sounds healthy. The key is whether it is medically necessary, properly documented, and allowed under the rules. So before buying something and assuming it qualifies, ask your doctor and check the current IRS guidance. The fourth strategy is using the HSA for eligible mental health care and travel connected to medical treatment. This matters because retirement health care is not limited to hospital visits. It can include maintaining your mental health, managing ongoing conditions, and getting to the care you need. Sometimes spending money on healthcare is not about treating a crisis. Sometimes it's about protecting your independence, peace, and quality of life. The fifth strategy is long term care insurance premiums. HSA funds may be used for premiums for a qualified long term care insurance, but there are age based limits. The amount changes depending on your age, and the rules can change over time. So I would not simply pay the entire premium from your HSA without checking the current limit. But this is worth investigating, especially if long term care insurance is already a part of your retirement strategy. The sixth strategy applies to people who retire before Medicare. For 2026, IRS guidance says certain bronze and catastrophic health plans are treated as HSA compatible under the new rules. You still need to confirm that you meet all eligibility requirements. A bronze plan typically has a lower premium but higher out of pocket costs. I've chosen a bronze plan for my own needs, and there are two advantages for me with this. First is that out of pocket medical expenses can be paid with my HSA, but premiums cannot be. So it is more advantageous for me tax wise to take this approach. Second is that while you are using a bronze plan, you can continue to add to your HSA up to the limit specified by the IRS. I've also done that this year because of the long term tax advantages. Finally, it's important to understand what changes after age 65. You can no longer contribute to your HSA beginning 6 months before you go on Medicare. You can use your HSA to pay for Medicare Parts A, B, and C premiums. And you can still use your HSA funds tax-free for qualified medical expenses. If you use the money for non-medical expenses after age 65, the withdrawal is generally taxable income, but the additional 20% penalty does not apply. That makes the HSA similar to a traditional IRA for non-medical withdrawals. Personally, I do not intend to use it this way. There will probably be enough qualified medical expenses along the way to make it worth waiting for those expenses to come up. Looping back to the tax implications when an HSA is inherited. An HSA does not receive the same treatment as a Roth IRA when you pass away. The tax consequences depend on who inherits the account. A surviving spouse generally receives more favorable treatment than another beneficiary. And for qualified expenses that are incurred before you pass, the IRS provides rules allowing payment or reimbursement from the HSA within 1 year after you pass away. So, this is an area where your beneficiary designation and your record keeping both matter. This is your gentle reminder to make sure that your receipts are in an easy place to find. I use the built-in receipt saving capability that comes with my Fidelity HSA. So let's make this practical. I recommend that you take these steps. Review your current HSA balance, and if you have multiple HSA accounts, consolidate them into one account to simplify your life. Gather receipts for past eligible medical expenses and organize your record keeping. Estimate your normal medical, dental, and vision costs, and consider your insurance plan in the context of potential HSA reimbursements and contributions. Check whether your long-term care insurance premiums qualify, and review your beneficiary designation. Your HSA should be more than a place where money sits untouched. And the goal is not to spend your HSA quickly. The goal is to be deliberate and give every dollar a purpose. Some dollars may pay for healthcare today, some may reimburse past expenses, and some may remain available for future medical needs. It can help protect your retirement income, support your healthcare needs, and give you more flexibility in how you use your other accounts. This is not a comprehensive list, and HSA rules can change. Please check current IRS guidance and consult a tax professional about your situation. If you enjoyed this video, please consider liking and subscribing. Thank you so much for spending time with me today. Take care and have fun on your retirement journey.